that will be revealed as we continue to execute the business. All right, so that's really kind of, there's kind of three big categories to that. The first one, look, when I was putting this talk together and I was thinking about this, I was going to spend some time going over what we committed to back the last time I was on this exact stage. So what was that? February of 2025. We made a bunch of commitments of what we were going to do with the company. I think it's just fair to say, like, it went pretty well. I think most of the things we said, we've delivered on. You know, we talked about we wanted to win in data center. We needed to establish data center as a major growth pillar of the business. That had been an issue with the company for quite some time. I think we're getting there. I think we just delivered significant outsized growth in the last fiscal year. And I think you're going to see that continue as we go through FY27. We talked about we're going to focus on the consumer business, and hopefully you stopped by outside and saw the products. They all look very different. It's the same products, different branding, showing up a different way. This is just an incredible brand that I think is in a bit of an unpolished gem, and we're continuing to work on it. We've gained 2 points of global share in that business. We'll talk a little bit about that business today, about why it's so important to the business model as well. We made some controversial statements at the time, quite frankly. We got up here and we said, hey, pricing is going to inflect positive in the second half of the year. And that became a big talking point. No, it's not. Yes, it is. No, it's not. Yes, it is. Turns out when we got to the end of the year, things were going in the right direction. And if anything, we significantly undercalled it. And so anyway, I think things went well. Those of you that believed in the company back then and invested in us, we really sincerely appreciate that. We take that very, very seriously to be good stewards of your capital. And we worked very hard, and you got a good return, and we're very happy about that. But that's the past, right? We're not going to talk about that. We can't go back to that point in time. That was a special point in time. It's not coming back. But what we can do is talk about going forward and how we're going to create value from here going forward. And I can tell you, everybody you're going to see up here on stage just has unbelievable conviction that this franchise, we're finally starting to reveal the true earnings power of it. And that earnings power is going to go on for a very, very long time. So we'll talk about that. All right, so let's start with this first. When we say, we have this capital allocation strategy, number one, we're going to invest in the business. That's always the most important thing, invest in the business. So what are we talking about? And one thing, I'll preface this by saying there are a lot of things we committed to doing back when we launched the company. And I think we were largely successful in making progress on those. But there's a lot of things over the last 18 months, and especially the last 9 months, where we were presented with some opportunities to really change the business, a lot of momentum. And we took advantage of those. And I think we have fundamentally restructured the business. And we kind of put a pin in the map on this day, early this year, realizing we could see what was happening in the business. We could see we were restructuring the business, and we're going to need to stand up and explain it all to you because it is very different what it was back in February. So anyway, with all that said, let's talk about all the things we did and kind of how we thought about investing in the business as we went. So the first thing, the most important thing, we're a technology company. Like, if you don't have great technology, you could probably you shouldn't be doing what we do. You always have to have unbelievable technology. So this is always the most important thing we're going to invest in. And I think we're in the best position we've been in a very, very, very long time as you look across the portfolio. Something I've been doing my whole career is investing in technology and thinking about this what I think of as a multi-horizon innovation investment plan. You can't just think about what's going to happen next or what's going to happen this year or next year. And you can't just think about what's going to happen 10 years from now. You got to think about all of it. And how do we invest across this entire horizon to make sure we have the right technology today, tomorrow, 5 years from now, 10 years from now. And this is where I think when you look at our business, it starts with what Ivan said. Kind of the engine of the company is the BiCS roadmap, is the fundamental NAND roadmap. If you don't get that right, it's kind of hard to make up for it at the system level. It's kind of hard to hide that. You have to have really good NAND technology. And we're constantly investing and many, many generations of NAND technology. We don't talk about all of them all the time. We just announced BiCS 10, I think a couple weeks ago. By the way, we announced BiCS 9 yesterday, and I'm sure everybody is confused. Like, why did you announce BiCS 10 like 3 weeks ago, and then you announced BiCS 9 yesterday? Because 9 is before 10, and we thought you would have announced that first. So Alper will explain that. I think it's very important. It's a very important point to understand. Like, the technology strategy is changing based on the fundamental BiCS architecture, and he'll explain to you how we now have multiple ways we can move this technology. So we're investing in BiCS 9, BiCS 10. There's actually people working on BiCS 13 right now. So one thing you should have confidence in, and this is with our partner Kioxia, we have a long roadmap of really strong fundamental NAND technology. You know, one of the big advantages of the JV, the big benefits of the JV, is we invest together on R&D. And together, we're a third of the market. So that means we can invest as much or more than anybody else in the market in making sure we have the best technology. So that's going to be there for a very long time. Alper will go through that. We also build the systems capabilities. You know, the BiCS investment gets you through the wafer, through the fab. The wafer comes out of the fab. I have to do something with it. You know, we could just go sell all the wafers, but we actually turn them into systems ourselves. So we have people working on all of the controllers, how to build SSDs, how to build all the different products in the markets we operate in across consumer, across edge, and now across data center. So you're going to see Khurram up here today. He's going to be talking about AI in the data center, and it's really his team that builds all this stuff. So just enormous systems expertise across all of these markets. And I think this is one of the big, if you look at the foundation of the company as a technology, one of the positions that we now are in, and one of the reasons I have so much conviction about the future, is we now have optionality across the entire market. We have a very unique consumer franchise. Edge, we've always been very, very strong. PC, smartphone, IoT, all of the things on the edge. And now we're very strong in the data center. So we've got all this optionality, and we're going to keep all that optionality, right? One of the big things of the strategy of the business is make sure that all of this technology remains very relevant, very on point, continue to drive this innovation across all these different markets. So that's always going to get invested in. Now we pick our head up a little bit, look a little further down the field. One of the things we talked about 18 months ago is we announced this product or this strategy around high bandwidth flash. If you would ask me, you know, like, a lot of stuff has happened in the last 18 months. This may be one of the things that is actually I'm the happiest about. You know, we basically stood up here and said, we're going to build this thing called high bandwidth flash. And I think the reaction was pretty much, what are you guys talking about? Like, nobody has any idea what you're talking about. What is high bandwidth flash? And we only knew high bandwidth memory. But we were kind of targeting this idea that, hey, when we get to inference, like, AI is a massive opportunity. At that point, all the focus was on model training, and appropriately so. But I think we were looking down the field, our team, especially this wasn't me, this Alper and his team, a tremendous amount of insight to see that, hey, you know, at some point we're going to move to this inference phase. You're going to have to scale this, and we're going to have to come up with a different memory architecture or storage architecture for inference to really scale. And we have an incredibly important technology that we can bring to the party. And so we announced it, and we said we're going to form an ecosystem, and we are going to start building this product. And, you know, Alper will be here later. That's the last talk that we're going to have today. He'll be here later and give you an update where it's at. But I think if anybody was at FMS last week, they probably saw there was a lot of activity around high bandwidth flash. And even last year at FMS, high bandwidth flash was awarded like the most innovative technology in the industry. So, you know, that's a horizon. And I know a big question is going to be, when is it going to ship and all this kind of stuff. But and we'll get to that. We're not going to get to that today, so it's a little bit of a spoiler alert. But we're getting there. I think the ecosystem is being developed. People are coming to the table. A lot of very good discussion. And so that is on the horizon. And then we look even further down the field. We had this idea of 3D matrix memory. little longer term project, continue to make progress. So we're basically, this is like the first priority, invest across all of these things and make sure they're all healthy and bring them to market to the extent that we're getting feedback that they resonate with our customers. All right, the second thing we talked about was get to this idea of a cash positive balance sheet, right? It's not exactly a novel idea, but it's like we need to get the debt out of the company. And I think this is something we're very happy about. It happened faster than we probably thought. We got a receptive market, and we got to this position where we don't have any debt. We have significant cash reserves, and one of the things Luis is going to talk about later today is this franchise. I think one of the things you guys are all seeing when you start to scale this franchise, it really is good at generating free cash flow. That's good, right? That's what we think our job is, to generate free cash flow for all of you. So we're in a position where we can generate a lot of free cash flow. What are we going to do with it? Luis will talk about that when he gets up here. But we feel like we're in a very good spot there. All right, now that was kind of like things we need to do every day. But once the business started turning, we started thinking about, okay, what else can we do to invest in this business? That's what we want to do first. First thing we want to invest in the business. So the way I think about this is we constantly go through a process of how do we systematically de-risk the business? How do we systematically make investments where we're basically de-risking the future? And there are a couple things that were a big part of that, right, that we were able to get done. First one was extend the joint venture. One of the first things you saw us do, we invested over $1 billion with our partner Kioxia, which was a recognition of the scale of this joint venture. But one of the first things we spent our money on was making sure we had production of NAND from 2030 to 2034. Right? That was very important to us because we have a tremendous amount of conviction in the future of this franchise. And if you want to be in the NAND business, you need to have a NAND fab. That wasn't always the case, by the way. Like part of the issue with the industry in the past is you could procure NAND very inexpensively because the people that own NAND fabs seemed to be selling it at prices that were not basically the marginal cost. I think that world is gone, quite frankly. My personal view is not coming back, and it's going to be very difficult to be in the NAND business unless you have access to a NAND fab, which we do, and we have it at scale. And we have, all the R&D benefits of that and all the manufacturing benefits of that. The other thing I hear sometimes is, oh, NAND's not that hard. NAND's a commodity. Anybody could do it, right? Well, if you actually believe that, I would encourage you to go to Yokkaichi and take a look at the fab that's there, right? And if you want to duplicate that yourself, find a lot of money, and I'll see you in about 10 years, right? It is extraordinarily difficult to be in this business, and this JV is a huge part, a huge strategic asset for us, and we took the opportunity to extend it when we could. Now, one other thing we did in this kind of de-risking, we knew that, look, we want to play in the data center market. Why do we want to play in the data center market? Well, you guys know all that. It's a very attractive market. But also it was the market that's going to help us change this dynamic with our customers. We want to go from this kind of negotiate price every quarter, this kind of highly transactional, highly volatile business, and we want to turn this into a business where we kind of dampen that cyclicality. We have more long-term relationships. We have more long-term visibility into what demand's going to be. And the customers that are most likely to do that are the data center customers, right? And there's a lot of reasons for that. We can go into that later if we want in the Q&A. But we have a willing partner that wants to go down that path with us. So if you're going to be big in the data center business and you're going to grow that business, you need access to DRAM, right? And we're no different than anybody else, right? The DRAM market is very tight, as they say. And so we needed to make sure if we're going to go to our customers and say, hey, we want to strike a 5-year agreement on selling enterprise SSDs, and we're going to put this huge contract together that's worth tens of billions of dollars, we need to make sure we have access to all the pieces to actually fulfill that contract. So this became extraordinarily important to us. It maybe wasn't as clear to all of you at the time that we were putting all these building blocks in place that was leading to this different contractual relationship with our customers, but that's kind of what we were doing. So we took we had the opportunity, we took a 4% equity stake in the company. It's worked out okay. I think we just took, Luis is smiling down there, our CFO. I think this quarter may be one of the few times where our GAAP earnings are higher than our non-GAAP earnings because we recognize like an $800 million gain on that investment. So that's been going well, but we didn't invest in it. We didn't invest in it for the return. It's great that we get that. We invested in it because we need access to the technology. So look, I think the net of all this is we've taken the opportunity over the last 18 months to really make sure the foundation of the business is just incredibly solid. We have the right technology, we have the right roadmap, we have the right innovation, we have the right relationships, we have access to all the things we need for years and years into the future. And then on top of that, we're going to think about how do we change the business model? How do we get this franchise where it's sustained value creation over the long term? And there's a lot of questions about that. I remember when I took this job, we went through the separation. Some of you were actually pulling me aside saying, Dave, what are you doing? Right? Why are you taking this job? Do you realize this industry has never made any money? And I'm like, yeah, I got it. Like, we'll figure it out, right? We're going to get there, right? We can change things and we can get a better outcome. That's one thing we really believe in. We can change things and get a better outcome. So how do we think about that, what we're going to change? This is kind of how I think about it. The three imperatives for sustained value creation. Right? So I've talked about these before, but I'm going to just go through them a little bit. Number one, we have to increase profitability. I think if you go back to that time of February of 25 when we launched the company, this was probably the big debate. I actually love all you guys because there's always a debate. No matter when we have a conversation, there's always a debate. And there's always a debate about something. And as soon as you get past that debate, there's a new debate, right? So there's always a debate. But the debate, I think, a year and a half ago was, could you get profitability where you needed to be? I think the debate today is the second issue. How do we reduce cyclicality? Now it's like, oh, okay, Dave, like we get it. Like we understand profitability is at a level it's never been before, but it's just a matter of time. Just a matter of time. You know, faster things go up, the faster they come down, all these kinds of things. So it's like now it's all about cyclicality. And we're going to talk about that, right? I think we're doing some things. Again, over the last 9 months, we've been extremely intentional about the way we run the business and the way we structure our relationship with our customers to try and reduce cyclicality. We're not saying cyclicality is going away. Right? The whole world is cyclical. There's a business, the whole business is cyclical. What we're trying to do is get this wild cyclicality of this business, just dampen that down, get more sustained value creation. And if you do those two things, in every business you got to grow. You got to get consistent revenue growth, right? And, you know, this is hard. In most businesses, this is hard. It's hard to grow. Like, usually you run out of TAM. And so you have to go acquire and do all kinds of things. And we'll talk about in this business, it's actually quite different. All right, so let's dive into these just real quickly. Last point, what I said earlier. You have to do this across all time horizons. It's not about maximizing value for the next 2 weeks, right? What's pricing going to do the next 2 weeks? That's important. You got to do that. You also have to do it across the midterm, the long term. So we're constantly thinking, how do we balance these things across all time horizons to get to this point of sustainable value creation? Right? So it's important. So you got to think in 2 dimensions. And a lot of the questions I get, a lot of the questions we get, tend to be about one of these things, independent of the other 2, and about a certain time horizon. And just so you know, when you ask us questions, what we're always doing is trying to translate your question into, okay, how do I think about that question across all of these variables and all time horizons and give you an answer that makes sense? Because answering point questions doesn't really help advance your understanding of the whole franchise of what we're trying to do. All right, let's just go into a little bit. Profitability. Like I said, honestly, I think profitability was always the one of these three that was just like hiding in plain sight. Like when I was managing the franchise when they were together, and we went to separate the company, it was this issue, will this business really ever create value over the long term? And to me, that seemed like I just didn't have a question about that, right? Because I thought the intrinsic value was always there. The question was, could you get the business model right? The way the business worked, the way you engage with your customers, like could you change that to actually let this intrinsic value come out? And it really kind of starts with this kind of observation. It's kind of a very simple observation, but I think some people forget it sometimes. We own the whole stack. We do everything, right? This is not a fabless semiconductor company. Like, that's impossible. And so we own the NAND IP. So the fundamental IP it takes to build NAND. What I said, one thing you should take away from the fact that I just said we have people working on BiCS 13, which is like going to be launched sometime, I don't know, don't come back and ask me 100 questions about I just said when BiCS 13 is going to be launched, but you're talking like well beyond 2030. People are working on technology a decade into the future, right? So this is like just on its face, extraordinarily difficult to do. And there are hundreds of engineers that have dedicated their lives to building some of the most sophisticated semiconductor technology. And that's just one part of this chain. All right, so we have all of that, and we have it at the largest scale, again, because of our collaboration with our partner, we have it at the largest scale of anybody in the world. And as somebody that's managed technology franchises for decades, very large technology franchises, your market share makes a big difference in how much you can invest in R&D. You can basically invest R&D commensurate with your market share. So what that says is when you get bigger, you should get better if you're doing your job right. And I think you're seeing that show up. You see that show up in our roadmap, and Alper will go through that. Once you have the NAND IP, we don't call somebody else up to like build the wafers, right? We have our own fabs with Kioxia. Like I said, they're quite spectacular. They're some of the largest fabs of the world. The scale we operate at is just incredible. So we do all the front-end manufacturing. Wafers come out of the fab. What I said earlier, we have another engineering team, hundreds of people that are working on all the systems expertise. How do I take this wafer, cut it up into die, put it in an SSD, put it in an enterprise SSD, a client SSD, put it in something that can go into a car, whatever it happens to be. We have all those people too. We're doing all that work. And as I said, across all markets, consumer, edge, and data center. And then we have the back-end manufacturing as well. You can go to Malaysia. We have a big factory there. We have a factory, again, with a partner in China. We do the back-end manufacturing too, and then, of course, we do the whole go-to-market piece. So, there's a lot of debate. There I say it. I said it. I'm adopting all of your language. There's another debate, right? And so there's this thing like, oh my gosh, your margins are so, your margins are so high. Your margins are higher than the fabless guys. Well, we do a lot more than the fabless people, right? Nothing against them. They're great companies, incredible companies. But when you look at this, there's just minimal profitability leakage across this whole model. So that's why I say this thing has been kind of hiding in plain sight the whole time. The issue was the business practice was wrong and you never could see it. And not only was it there, but we've been doing this for like 25 years. It's like crazy. Like we've got like 25 years of paying engineers like hundreds of millions of dollars a year. Right? These engineers, they're not cheap, they're like expensive, they're a little bit temperamental sometimes, they can be hard to manage. They're wonderful people, I'm one of them, but it's like not something you just roll out of bed and do. So we've been investing that for years, decades. And quite frankly, one of the things I see today when people say, oh, like this is just memory, it's a commodity. I'm like, yeah, you try it. Like, you try to do this stuff. It's like incredible what people are doing. And so we've been investing in this for like decades. In fact, Alper will be out here later. He leads this team. A lot of the people in that team have been at Sandisk like way before the Western Digital phase, right? That was just like a little phase of the company. So we've got like this huge amount of expertise there. And then on the manufacturing side, we've been investing billions of dollars. Again, for 25 years, we've just been investing billions and billions of dollars of building out this incredible scale manufacturing capacity. So, in many ways, like I said, I think this profitability thing was just hiding in plain sight. This thing is like a coiled spring that's been fed for like 25 years, and it really hasn't produced, and now it's producing. And now it's about how do we sustain that over long periods of time. And again, I think hopefully one of the things you take away from today is that the way we're engaging with our customers, the way the level of strategic engagement has fundamentally changed that allows us to completely reveal the profitability of this franchise. Now, a little bit, what did it take to get here? Like, how did this get unlocked? Again, if I go back 2 years ago, it was like, oh, Dave, can NAND ever be 50% gross margin again? Like, yeah, of course it can, right? So I think we've kind of put that to bed. But the issue was we just have to proactively manage this business from the supply side. I think 23 showed us, like the great meltdown of the industry showed us, that if you manage this from like, I have new technology, I should release it, that's going to lead to a bad economic outcome for us. And I'll go through a little bit of that later about why that's the case. So a little more proactive supply management, and pretty soon things come into balance. And this next statement may be a little bit controversial. I actually think the market is adjusting to these dynamics quite quickly. And I think that's one of the things we're here to talk about. Right? The market is changing actually quite quickly in the way we engage with our customers around securing future supply. It's moving rapidly from this quarter to quarter to multi-year timeframes. All right, let's talk about cyclicality, the current debate. All right, so how do we think about cyclicality? So you may be surprised, I said earlier, the first place I think about this is the consumer business. It's one of the reasons why the consumer business is so important, right? Why is the consumer business important? 351,000 points of sale around the globe, right? This global brand equity. You can almost go, it's fun, it's fun in this job because you can almost go anywhere in the country, anywhere in the world, and people know our brand. There's, last time I was in China, there's always a photographer. I pulled him over and said, hey, open your camera. He opens his camera. He's got a Sandisk card in it. It was great, right? So people know us all over the place. Billions of products sold in the last decade. The dynamic range of this company is incredible. We sell like a single product to billions of people, and we sell billions of dollars worth of products to single customers. That's kind of what the estate is across the whole thing. But let's look at the financial dynamics of this. I don't think we've ever showed this chart before. But this is industry gross margin going back to the first quarter of 2017. So there's the cyclicality for you. And you can see the great 2023 washout that kind of impacted how we changed the business in a major way. But if we plot consumer gross margin on top of this, you see that it generally tracks the business over almost all time periods, but especially when you start to see the down cycles, it insulates you from those, right? Because it's just a broad-based market. So it's like this shock absorber on the business that allows us to generate a consistent level of profit on the base of the business over long periods of time. And you can see, I don't expect 23 to come back, by the way. Like, I know some of you are waiting for that to come back. I don't expect that to come back. But you can even see, even in the darkest days, maybe in the history of the industry, this business was still producing profit, right? So very important business, will always be an important business, and it's a great asset to the company. But it's not enough, right? The issue is it's not big enough. Not big enough to insulate the whole business. It's great It gives you some protection. We need to make it bigger. By the way, that's the key of why we're taking a brand-first approach to this business. It's about growing it, right? Financially, it's a great business. And there's actually some little tricks behind the scenes that make it very profitable because we can use more of the wafer in this market than we can in other markets. There's lots of little things like that goes on. But it's about growing this business now. And like I said, since we launched the company, we've gained a couple points of share globally. It's hard to do. We've rebranded the whole portfolio again. Janet is here. She leads the business. Stop by outside and see all the great new products. So it's not enough. So this is where we really went into this whole concept of new business models. Right? And we've talked a lot about this last couple of quarters. We've tried to be very transparent on what we're doing. Right? As transparent as we can be, given these are like confidential customer relationships. I'm not going to go through these in great detail because Luis is going to go through these in great detail. And he's the best person to go through them in great detail because he's actually the guy that's negotiating them. So that should tell you one thing about how important they are. It's like literally the CFO of the company. And now there's a lot of people around, there's a big team, but he's the one that's like got his hands on the steering wheel of what all the terms and conditions are and what we'll agree to and engaging at this most strategic level with our customers. So I'm not going to go through all this detail. Luis will go through it. The one thing I'll tell you, like, I've just heard a lot of stuff about these agreements. Just incredible. There seems to be people that are very informed about the way these work that have never read the contracts. Right? It's incredible. I watch TV and people say, oh, there's more holes in these things than you can imagine. I'm like, really? Like, how would you possibly know that? Like, there's like the number of people that actually read these, you don't really have to take your shoes off to count the number of people that have read these contracts. Like, it's like just both hands, right? They're just like incredibly detailed, incredibly strategic, very, very consequential, and they're different than what has been done before. We have a lot of confidence in that. There may be a lot of reasons you choose to invest in this company or not invest in this company, but don't choose because you believe something about this just based on the history, the way the industry has always worked. Take the time to understand how these things really work, and I think you'll get some of the conviction that we have about why I can make a statement. I feel like I'm finally at the starting line of where the real value creation is going to happen on a sustained basis. Now, I will say this long-term customer visibility, demand visibility, and pricing stability is replacing this quarter-to-quarter world. It's a crazy industry. Everything is negotiated constantly. I only have to go back like 3-4 quarters. Everything is negotiated. We come into a quarter, we're still negotiating with our customers on what they're going to take and what the price is going to be. We have like 3 months of visibility. And we're making investments that are 10 or 15 years long. We have 3 months of visibility. Within 2 quarters, we've gone from 3 months of visibility to over 4 years of visibility. So what I said earlier, I think the market is adapting very quickly to these changes. I think that's 100% true. 2 quarters is very quick to have customers of this scale, and we can say things like 50% to 2/3 of our supply is under agreements, and we have like average visibility of 4 years. That happened in 2 quarters. It's kind of amazing. And I can tell you, even since our earnings call last week, the number of customers that are coming to us, and now they're proposing the agreement, not us. We started with, we would go to them and we would propose like, hey, how do we put an agreement together, get more visibility? We got some people that wanted to work with us and we got it done. Now it's turning, not everybody, don't get me wrong, not everybody, but now I'm starting to see customers are coming in and proposing, hey, how about we do a 3-year deal? How about we do a 5-year deal? Here's what we'll offer on pricing. Here's kind of how we'll do the financial guarantee. So this market is changing very, very rapidly. All right, the third part of this is there's still high-value businesses where customers are not going to sign multi-year agreements, right? We're going to stay engaged in these businesses. We want to stay engaged in the whole market. I think one of the very brilliant things about the NAND business, it's kind of an evergreen business. There's always something new. right? There's always something new. There's always a new device. Like, this is the magic of innovation. Somebody's always thinking of something brilliant. We don't know what they are. But when they think of those things, if they have to store data, they're going to use NAND. So we want to make sure we have some of our supply available to make sure we can play in those markets. There's very important customers and very important businesses that maybe don't have the scale. So there'll always be a way to play in this other part of the market. And quite frankly, there's also going to be some customers who just want to do business the way it was done a year ago or 2 years ago. And we'll continue to engage in those markets to the extent we have the supply to make it available. So we're going to meet our customers on their terms. And we want to stay, like I said before, we want to stay engaged in the whole market. And one of the things about this business, again, one of the things that encouraged me a lot about this business a couple of years ago when we were talking about coming to work here full time, was we have a spectacular set of customers. I mean, we have like the who's who of technology companies in the world as our customer base. So that's amazing. We want to stay engaged with all those customers to the extent we can. All right, so that's cyclicality. I know it's the current debate. I'm sure we'll continue to debate it, but that's kind of our view of why we do think this market is changing very, very quickly, and this is a very intentional strategy to try and change the relationships and kind of bridge this gap of, like, on the supply side, having 3 months of visibility, right? But we have to make 10-year investments in fabs, and we end up in this vast middle ground where it seems like nobody is happy, right? Either the supply side is like scrambling because we're not making enough money to invest, or the demand side is upset because they can't get everything they want. It's hard for me to see how that strategy works for anyone, and I think we're now rapidly converging to something that is a little more sane, and we can all get enough visibility to make sure everybody can get what they want. Like, again, what I tell customers, like, you want to buy NAND? You're in luck. We sell NAND. And not only do we sell NAND, we have the whole stack, right? We have all the IP, all the production from beginning to end. So I think we're getting to a very different spot. All right, I'm going to cover one more thing. And I think as an investor, this is important. This is important for you to understand. And we've talked about it before, and maybe you already understand it, but I just want to bring it out. We talked about growth. And again, my experience in running a lot of technology franchises, this is kind of the hard one, especially when you get to very good economics. Because when you get to good economics, you kind of start running out of TAM, right? And so you have to then figure out, how do I expand my TAM? How do I develop new products? How do I move into new markets? How do I go acquire different companies? All that stuff, I've done all that stuff. It's all expensive and it's very difficult. We have kind of the opposite issue. Like, we said, we're going to commit to grow we're going to grow supply, we're going to grow volume mid to high teens, and then we debate, is that too big or too low, right? Oh, it could be higher. Well, it could be lower, right? It's like last year, if we went to February 25, people would probably say, oh, that's too high, right? Pricing is going to go down. We got to January, and it's like, oh, that's way too low. We can go higher. But we're committed to this kind of mid to high teens volume growth. When we look at the whole market, we think this is sustainable over long periods of time. And when we talk about mid to high teens growth, I think one thing that's important for all of you to understand, it's become clear to me over the last couple of weeks. When we talk about mid to high teens volume growth, we talk about that as an input to a process of developing like a whole fab strategy. And we were talking yesterday, and I asked somebody on our team a question, which I'm not going to tell you the answer to, but the question was like, what's going to be our BiCS10 mix at the end of the decade? They pull up a spreadsheet and they tell me, we have a plan already. Like, we have a fab plan like years and years and years in advance. So this investment is the input into that plan. That plan, over long periods of time, grows volume mid to high teens. Now, the output on a quarter-to-quarter basis or on a year-to-year basis is going to have some variability in it, because things change in the quarter you're in. If you just pick two endpoints and you say, oh, you're growing faster, you're growing slower, it depends what endpoints you picked, right? CAGRs are very, very sensitive to endpoints. But again, one thing, we're committed to this grow volume mid to high teens. Some quarters it's going to be less, some quarters it's going to be lower, some years it's going to be higher, some years it's going to be lower, but over long periods of time, this is what we're going to grow. And that's an amazing place. If you can get the economics right, you get the cyclicality dampened, and then you grow, that's an unbelievable franchise, right? And you'll see it in the business model that Luis talks about. But this is important. How do we grow? How do we grow? This is really important as an investment point of view. How do we grow? So you go back to the BiCS roadmap. Bit cost scalable roadmap. We say BiCS all the time. Sometimes people don't know what it means, right? It's right there in the title. Cost scalable, right? How do we build this scalable technology? So I was sitting at my desk a couple weeks ago, and I just pulled out some material, and I said, let me do some calculations. Let me look at this. And I looked at about a 10-year period, right? About a 10-year period from calendar year 20 to calendar year 30. And I looked at kind of the plan of launching nodes across that 10-year period, or 9 years, let's call it 9 years. 5 nodes over 9 years, right? BiCS 5, 6, 8, 10, 11. Now, again, there's a BiCS 9 in there. Alfred will explain that. But these are the big major nodes. The average generation to generation bit growth per wafer was 54%, right? It's a pretty impressive number. Every time we put a new node in the market, or every time we turn the crank on that innovation engine I talked about, we get 54% more output per wafer. It's kind of amazing. Now, the issue is we don't do a node every year. So five nodes over 9 years, you can do the math on what that is per year. Now, when I was a young executive, they sent me to PR training. And one of the things they told me in PR training is never make the statement, you can do the math, right? Because nobody does the math, or nobody can do the math. So now all of you can do math, I'm pretty sure, but I'm going to do the math for you. And so when you back that out to a yearly CAGR of productivity growth, it's 27%. So through the application of innovation, we can grow output per wafer at a rate of 27% a year. Which, by the way, tells you you can't just release nodes whenever they're available. Otherwise, you're going to flood the market with supply, and then you're going to have another 23 situation. But that's in the past. But what this tells you from an investment point of view, what it tells me from an investment point of view, is growth is primarily driven in this business by the application of intellectual capital, not financial capital. It's the paying of those engineers and those NAND designers to continue to drive that roadmap forward is what is going to drive the growth. Now, there is more CapEx. Each node is more steps is more tools is slightly more clean room space. Right? But you can see from this equation why we're constantly, you have to reduce wafers on an ongoing basis because the technology you have is so productive. So it's like getting the business model around that really, really high-powered engine, getting that right, and it's an incredible business. And what this means is, again, from an investment perspective, the ability to take bits, turn them into revenue, and then revenue to free cash flow is quite high. And I think at scale, you have a franchise that has an extraordinary ability to generate free cash flow margins, right? And you'll see a little bit of that later on. All right, that's where we are. That's the big picture. I'm going to turn it over now to the people that are really driving all of this fundamental technology and financial greatness. So Alper is going to, as Ivan said, Alper is going to come up. He's going to talk about the NAND roadmap. As I said, you're not going anywhere in this business if you don't have the right roadmap. And he is expert on this. We have a lot of people working on this. He'll tell you about BiCS 8, BiCS 10, where that's going. We made this statement on our earnings call last week. Earnings calls are always fascinating events, because something always happens you don't expect. I love earnings calls. Everybody, like I talk to my peers and they're like, oh, I have never heard somebody say they love an earnings call. Like, we love earnings call. We get to talk about our business. But we made this statement that said we think the market's going to be $300 billion this year and $500 billion the year after that. Right? And everybody's like, oh my gosh, like we never heard that number before. And they started backing into thinking that was like a revenue forecast for 27. It wasn't, right? It wasn't. One thing you need to understand about that number, it includes China. So when you include China, it skews the numbers if you're trying to back into everything else in the world. And that's an exercise left to the reader to figure out what that is. But, Eric Churchstrom, we have a team on market intelligence. This is why we were able to stand up here last year. And we said with conviction, we thought pricing was going to inflect in the second half of the year. And that was another debate, very debatable. And the reason we had conviction in saying that is because of the work Eric does in his team. So we thought we'd give you some visibility into how he thinks about this and kind of how he thinks the big picture of how this market has kind of resettled over the last 2, 3, 4 years. Very important to understand this. Not only is Sandisk changing, the playing field we're on is changing dramatically. And I think when you understand the dynamics of that, it starts to unlock some of this value creation as well. All right, Khurram's going to come up. He's going to talk about AI inference. There's obviously a massive tailwind to the business right now. There's a lot of questions, a lot of conversations about KV cache. How is NAND used in inference? He's going to try and demystify all that a little bit, how our products fit into the data center. How do we think KV cache is going to grow in the future? And then Luis is going to come. He's going to wrap it all up into the business model. He's going to go through the NBMs, a little more detail. And just like last time, we're going to put HBF, we'll talk a little bit about 3D matrix memory too. We're going to put it at the end. And the reason we put it in, it's not in the model yet, right? When it's in the model, we'll tell you. But until then, what Luis is talking about is the model for all the core business. And you should see these as like future innovations that we'll continue to update you on. But I think Alper will give you a very good view of all the progress that's happened in the whole world around HBF in the last year and a half. It's really been quite exciting. All right. Thanks for your time. Thanks for being here again. And I'm going to turn it over to Alper to get into the technology. Thank you.
Please welcome Chief Technology Officer at Sandisk, Alper Ilkbahar.
Thank you. Good morning. Good morning. Great to see all of you. Welcome. Welcome. I'm really excited to be with all of you here and talk about the memory technologies our teams at Sandisk are driving. So let me start off highlighting the main pillars of our technology strategy. Our number one priority is to keep our exponential scaling engine running. In semiconductors, especially in memories, scalability is the most critical factor we're looking for. And you're going to hear us talk about scalability, the importance and the role it plays in our business over and over today. And we're going to talk about how our 19th generation strong scaling engine keeps going and how our roadmap extends well into the next decade and beyond. Next, we are laser focused on what our customers are looking for, which is performance, power efficiency, and density. You're going to hear from us how we are leading in every single one of these metrics and how we're delivering the most capital efficiency amongst our peers in the industry to deliver superior financial results. And finally, we strive to innovate to amaze. We are innovators, we are engineers, technologists, and we are really looking for ways of improving all the applications and products every single day, but not only the existing ones, but we're also innovating in creating new applications and new markets every single day. With that, let me start jumping into the next slide here. This is a slide that I shared with you last year in February here on the stage. And at the time, I shared with you how since 2001, our teams have delivered 17 generations of NAND technology. So today, only 18 months later, we have added 2 new generations of NAND technology, BiCS 9 and BiCS 10, to our roster. This data tells me 2 important things. The first one is the pace of our innovation is accelerating to match the demands of the markets. And number 2, NAND flash, being the most scalable semiconductor technology, is actually the only technology that can match the exponential growth of AI. And that's why you're seeing, and will continue to see, the increased adoption of NAND in AI architectures. Last year, I also showed you this slide to explain the vectors that are driving and fueling our scaling engine. At the time, I had talked about how we are prioritizing the more technically difficult but significantly more capital-efficient ways of scaling, which are lateral scaling, logical scaling, and architectural scaling. These are our priorities over the easier, yet financially more challenging and costly vertical scaling, which is adding layers. Our strategy hasn't changed, and we are really pleased with the results we're getting through this strategy. And it's exemplified in this slide. I shared a similar data with you last year. At the time, the data ran through 2024. This year, we added 2025 as well. And what we're showing here is capital intensity of Sandisk and our JV partner Kioxia, and compare it against the capital intensity of the industry. And we are defining capital intensity as how much CapEx we have to put there to get an incremental petabyte of bit output. Of course, the higher that is, the worse you're off. So you're trying to minimize your capital intensity. And the white line here is showing the average of the industry divided by our numbers, so the ratio to that. So now this data, what it's telling you, is in every data point, by the way, here is backward looking for 3 years and averaging that. In 2025, the industry spent, on average, 2.66 times more capital than we did to generate the same output. 2.66 times more. So this is the capital efficiency our strategy is delivering. Looking at the same data through a different lens, here I'm showing you the percentage output, bit output of each of the peers in the industry versus the percentage of the CapEx they spend every year. Actually, we're looking here in a period of 21 to 25, so this is a 5-year period we're looking at. So on the left, you're going to see that between us and our joint venture partners over that 5-year period, we produced 29% of the industry's bits, while spending only 13% of the capital. 29 versus 13. So when we look at these ratios for each player, one by one, I captured that data on the right side. What you're going to see is that our capital efficiency is just about 2x that of our nearest competitor. And this is possible through our technology strategy that I just highlighted, through our execution of that incredible technology roadmap, our scale, our operational capabilities and excellence, as well as the intense focus we have on tool reuse, all of which make this possible. And delivering superior financial results for all of our investors and shareholders. Now, as we're pushing our technology forward and pushing the limits of scaling in every single generation, we actually advance the technology across two dimensions. The first dimension is what I'm capturing in the x-axis here. Every generation gives us more bits. This is happening through pursuing those 4 vectors of scaling. Next, and you have seen earlier, every generation we get 50 to 60% more bits, and that's happening through scaling. The other frontier we pursue is what I'm capturing in the y-axis here, which is performance and power efficiency. And we get those improvements in every generation as well through device and design innovation. Now, you have seen this roadmap before. I'm mostly going to talk about BiCS 8 and 10 today on that roadmap. But as you heard earlier, our teams are already working on BiCS 11 and beyond. And the scaling engine continues running, and we see actually no end to the scaling limits in the foreseeable future. So we're going to run this for a decade and longer, of course. Now, we have talked earlier about our CBA technology, which is our hybrid bonding technology, where we're able to combine 2 different wafers to make a single wafer. By utilizing this innovation, we're actually augmenting a derivative roadmap, as I'm showing here. This CBA-enabled roadmap allows us to take an existing technology node and push its performance and power efficiency to the next level by combining the memory array technology of that node with the next generation CMOS technology and combine the 2 wafers together and get to the next level of performance. So you may ask, why is that relevant? Why is that important? A great example for where this is needed is actually happening in the data centers right now. The storage interfaces in the data centers, and what I mean by storage interfaces, think about our enterprise SSDs. They run on a standard interface called PCIe, and there's a transition that happens industry-wide from it, say Gen 4 to Gen 5 to Gen 6. These transitions used to happen every 4 or 5 years in the past. That time allowed us to essentially move from one technology node to the next one, ramp that technology, and maybe ramp the next one as well, so that we would have plenty of supply and transition our products gradually into the next generation of this interface. But with the advent of AI, these transitions started happening significantly faster. And when the demand turns on in the data center with the volumes that we're looking at, you have to enable that transition extremely fast. So you may not even have time to ramp your next generation technology node to meet that demand. So what do we do with this CBA-enabled derivative roadmap? We can take our existing technology node and very quickly move it to the next performance level and make that transition happen. Move our entire portfolio very quickly to what our customers need and customize the silicon very rapidly. And the beauty of it is that it can be done with very minimal additional capital spending because we're leveraging the existing nodes memory array technology, which is where most of our capital sits. So this is a super efficient way of moving to the next level of performance. It gives us incredible operational flexibility, it gives us great capital efficiency, and it gives us the ability to meet our customers' requirements very quickly. So it's an awesome innovation, a technology competitive advantage that we can leverage and create incredible competitive advantage for our business. So I'm going to talk about BiCS 9 in a quick bit, but before I get to it, I want to take a quick look at BiCS 8, because BiCS 8 today is the backbone of our current production. And it is the industry's gold standard. We introduced the CBA technology, the hybrid bonding technology, first time with BiCS8, and it has given us tremendous competitive advantage in performance, density, as well as power efficiency. And it turns out that these are exactly what our AI data center customers were looking for. So when we compare BiCS8 against some of our peers' performance and power efficiency numbers, we've seen tremendous gap where we had a huge advantage. And here I'm comparing our BiCS8 against our peers' 2XX generation memories. Of course, our peers are moving forward. They're announcing their next generation products, which we call 2YY or 3XX products. And they're improving their performance. But when we look at the power efficiency, we're seeing that their power efficiency is really not moving a lot better. Now let me put on what's coming, BiCS10, and show you how BiCS10 is going to compare against these. So this is where BiCS10 is coming out to be. BiCS8 was amazing. BiCS10 is going to be even better. And I think it's going to be the gold standard for the AI data centers very soon. So we'll get to BiCS10 in a bit. But let's first talk about the latest news. We talked about BiCS9. So BiCS9 is the first product where we're essentially deploying this hybrid technology, hybrid bonding technology extension. What we have done for BiCS9 is we've taken the BiCS8 salary, the mature salary we have, and combined it with the next generation CMOS wafer. And through that, we achieved tremendous performance gains. And we've done so with minimal incremental capital spending. So we essentially are upgrading our BiCS8 deployment supply bases to the next generation performance level with minimal capital. And we designed BiCS9 based on the specification from our large hyperscale customers. They wanted to have incredible performance, they wanted to have a lot of it, and they wanted to have it yesterday. So this allowed us to achieve all those objectives very quickly. And I'm very happy to report that this product is already as part of our NBMs, and our customers can't wait to have this. So it's going to power our next generation storage SSDs that Khurram is going to talk about. So really looking forward to seeing this powering your AI very soon. Okay, let's go to BiCS10 real quickly. I gave you a sneak preview of this BiCS10, the first product in the BiCS10 lineup last year. This is the 1 terabit TLC die, again achieving tremendous improvements over BiCS8, which is the best in the industry. Since then, our teams have done a marvelous job with this technology, and it progressed ahead of our expectations. So it allowed us to start sampling this die to our customers as of this month, which we just announced. The second product in the BiCS10 lineup is the 2 terabit QLC die, QLC being 4 bits per cell technology. We're really proud of this technology. It actually is the highest density memory chip in the world. And while delivering this, we have achieved more than 60% density improvements over BiCS8, more than doubled the read and write bandwidths, as well as improved the power intensity and efficiency by 75%. These are truly amazing numbers, considering that we're beating the world's best NAND, BiCS8. To give you a better picture of the power of scaling, I wanted to show you BiCS8 and BiCS10 2 terabit dies side by side. So this is what we are able to do with the scaling engine. Each BiCS10 2 terabit wafer has 65% more bits than the BiCS8 2 terabit. So you have the pictures here, but the wafers are sitting outside. So I will invite all of you to please go out and check in person and experience that scaling. The wafers are sitting out there, and then you can even touch and play with it if you want. So, putting this in historical perspective, going back to the data that David showed you earlier, and we're looking at the generations from BiCS 5 through BiCS 10, and even projecting into what's coming next, BiCS 11, we're delivering 27% CAGR on bit growth per wafer annually. 27%. And you already heard that our production plans are based on our long-term demand forecast of about high teens. So this is delivering roughly 50% over that, which means that we have the technology productivity to meet all of our production needs and plans just by scaling the technology alone. As a matter of fact, because of this productivity, our wafer starts have come down over time. And that's another way how we have created value and driven our capital efficiency. So with that, I thank you all for being here. I will be back to talk to you about HBF at the end of this presentation, and I will invite Eric to be with you to share his intelligence insights in the market. Thank you very much, and see you soon.
Please welcome Vice President, Market Intelligence at Sandisk, Eric Cherstrom.
Good morning. I'm excited to be here to give you a brief NAND market update. We expect the flash market to reach 1.2 zettabytes of shipments in 2026. So how did we get there? Well, as you know, this industry started with growth in the consumer and edge. The key drivers were phone scaling to 1.5 billion units of annualized shipments, PCs shifting their storage needs from hard drive to flash, and the emergence of the enterprise SSD. Then, in 2022, ChatGPT was launched. AI propelled the data center segment and increased its share of TAM over time. Data center share of TAM in the early 20s was 20% of bits. Last year, it was 30%. This year, 50%, and continues to outpace the market. So now when you think about the revenue, overlaying the volumes from the prior slide, you can again see two distinct periods. Period one, flash was priced as a commodity. ASPs reduced, offset volume gains. The historical average during this period of time for the industry was $60 billion, and we measured cycles in $20 billion increments. Now, flash is a critical component of a multi-period data center build-out, and this leads us to believe that the flash market's going to grow to over $300 billion in calendar 26, and again grow to nearly $500 billion in 2027. So what was going on with supply during the same period of time? Well, in the late teens, the industry was targeting over 30% annualized bit growth rate. The industry had to invest, growing wafer starts, all the way up to 1,800,000 wafers per month in 2022. At that peak of wafer capacity, COVID-related inventory digestion dramatically reduced flash industry demand. Supply side had to react, underutilizing 500,000 wafers per month and structurally resetting their capacity to 30% below peak levels. In spite of that reduction in wafer capacity, industry was still able to achieve mid to high teens production growth rate via nodal migrations. So let's talk cloud. The chart on the left shows US data center CapEx for select hyperscale and neocloud customers. The chart is showing the projections over time. And as you can see, starting in 2023, we have seen 15 consecutive quarters of upward revisions to this selected CapEx. Current estimates show that $1.9 trillion of capital will be spent by these companies in 2026 and 2027. And we believe monetization is coming. the most recent Amazon earnings call, they talked about not having enough capacity to support near-term demand and the fact that AWS could reach nearly $1 trillion of annualized revenue. Shifting to the edge is going through a transition period. The chart on the right shows our expectation of unit decline year over year in the mid-teens for both the PC and mobile segment. And as you can see, all of this reduction is being driven by the low-end devices. Our belief is that OEMs will shift their mix to more premium offerings, and ASPs will continue to grow. ASPs and revenues will continue to grow in 26 and 27. And as you can see from the most recent earnings of major OEMs, year-over-year revenues grew between 13 and 24%. So Flash is entering a new reality, a reality where data center is the majority proportion of the share. Edge continues to mix to premium devices, and on the supply side, bit growth targets are met via nodal migrations. All of this put together gives us the conviction where we see the market opportunity growing over $300 billion in 2026 and can approach $500 billion in 2027. With that, let me pass it over to Khurram to talk about the era of inference.
AI doesn't run on magic, it runs on data. In the era of inference, that data moves through a repeatable loop we call the AI data cycle. Each stage in this cycle is unique and demanding in its own way. Let's go on a journey through the AI data cycle. Stage 1 is the raw data archive, where information lives. Think everything an organization collects: articles, videos, social posts, business transactions, and internal knowledge. It's massive exabytes to zettabytes, and it's the source of truth. But raw data by itself isn't ready for AI yet. Stage 2 is model data preparation. Raw data is extracted, transformed, and loaded, also known as ETL, to clean it up, organize it, and make it machine ready. A key step is creating embeddings, which turn content into numeric vectors so computers can group and search by meaning, not just keywords. And for AI training, the system has to pull data randomly from across the entire enriched dataset fast and at a very high throughputs. Stage 3 is model training. Massive GPU clusters process that prepared data to learn patterns and build a model. Training can run for a long time, so the system regularly saves progress in checkpoints. If something fails, you can restart from the last known good snapshot instead of losing days of work. Because training pauses during checkpointing, the faster those snapshots write and store, the more time the GPUs spend learning. Stage 4 is inference, when trained models are actually used to answer questions and generate outputs. Real services may swap models depending on the task, so keeping the right models ready matters. Inference also often uses retrieval augmented generation, or RAG, to pull the most up-to-date, trusted context from a vector database to ground the response. To maximize efficiency, systems use KV cache so GPUs can reuse previously calculated values instead of recalculating from scratch. As more tokens are generated with agentic workflows, the more valuable this cache becomes, and the larger it becomes. These high-capacity KV caches are tiered onto SSDs. Stage 5 is new content generation. The model's outputs are stored immediately so they can be delivered to users and reused for things like fine-tuning and ongoing consumption. The newest content is accessed the most. Then it ages into long-term archives, becoming tomorrow's raw data. And that's the AI data cycle. Collect, prepare, train, infer, generates, and repeats.
Please welcome Chief Product Officer at Sandisk, Khurram Ismail.
Good morning. I'm Khurram, and I'm here to talk about the infrastructure outlook, specifically as it pertains to Flash. The good news is that we are almost at halftime, and since we don't have any breaks for halftime, I get to be your host for the halftime. So let's get into it. So David talked about engineers being at Sandisk for a long time. I'm one of those. I've been in this industry for 27 years, all in memory. And never has been a time more exciting for memory than it is now in AI. I've seen all sort of peaks and troughs. The pace of innovation that AI is bringing is tremendous, and we all can see that. We see the new frontier models being loaded, right? The system architects are changing the design every 6 months. So the pace of innovation is quite rapid. But the infrastructure required to deploy that innovation is also being deployed at a very unprecedented rate, right? So what is the role of flash? In my talk for the next 20-odd minutes, I want to leave you with two things. First, like David mentioned, our conviction on the critical role that flash plays and the size of the opportunity. The second one, I hope you gain the appreciation of flash is not really a clumpy device sitting at the edge of the infrastructure, but it is actually being proliferated through all the layers of AI infrastructure. So I want to start with some fun facts, as I'll be going over some concepts, and I think it'll help us understand those concepts if I draw some analogy to the human brain. Maybe some of you know, I was just doing ChatGPT, Gemini, and I found an interesting fact that each human brain is wired with 2.5 petabytes of memory. Now you multiply that by entire human intelligence, that's like 20 yottabytes of collective human memory. Now 1 yottabyte, I had to look that one up too. I work in zettabytes and exabytes, right? So 1 yottabyte is 1,000 zettabytes. Now you look at the right, at the cloud infrastructure, which I would characterize as being very early in the innings, is only hundreds of exabytes to maybe 10 zettabytes, all memory combined, right? One could argue, looking at this, as we are going to scale intelligence, the cloud infrastructure can use more storage, right? The interesting thing about human brain is it works with two types of memory, the short-term memory and long-term memory, and they both work hand in hand, utilizing each other to generate intelligence. Turns out the AI intelligence is built on very, very similar concept. You have a transient short-term working memory that is called ephemeral KV cache, and we'll cover that. And then you have the long-term memory, which is a little bit of more persistence, which is known as persistent KV cache. So there is similarity. They both work on the same principle on how humans store data and process data versus AI intelligence. Okay, so Eric talked about the total demand in 2026 to be 1.2 zettabyte for entire flash market, right? Here I'm only focused on 2030 AI data center TAM, which is equivalent to what we ship as a total output as an industry in 2026. So the opportunity is massive. And I'll come back to this slide again as I go through why that is the case. But it's important to note, as I mentioned, flash is not just a single device sitting at the edge of infrastructure. There are many workloads that are emerging on flash, specifically in AI data center. What are some of those workloads? Well, you have first fast data lakes. We talked about it last year. These are the massive data lakes that require massive storage. Second is staging. These are a little bit, direct attached device close to the GPU for training, checkpointing. So that market, is having a tremendous growth. And last is the KV cache, and that'll be the focus of our conversation because that's the fastest growing segment in AI data center. And when you look at the composition of NAND technology, we see that TLC is dominant technology in 2030, and QLC still has a very good, decent sized share. So, how's the infrastructure being viewed today? And the thinking around infrastructure is changing. We are moving from what used to be total cost of ownership to the total value of ownership. In the past, when you deployed the infrastructure, you sort of prioritized cost running at very large scale, and some of those considerations are listed here. With the total value of ownership, the equation is changing. Infrastructure is no longer being viewed as a cost center, but really a driver of value generation, right? And in this case, the value and the output is intelligence, right? So the race to scale the intelligence is heating up. As you can see, everybody's trying to generate more tokens. They're trying to get more users on their systems or on their AI. But with this scale, there's a lot of challenges that come, right? There's always the challenges of power, right? Where do you store? Do you store these tokens in volatile media only? There's not enough volatile media. What role does non-volatile media plays, right? And then there's shifting architectures, right? We're moving from training to inference. And turns out Flash solves a lot of these problems, and that's where I'll be taking you next. So you saw the video, the era of inference. The only point I would make here is a lot of focus in the AI data as it flows through the infrastructure is on inference. So I presented this 18 months ago, last February in 2025, the 5-stage data cycle. The first 3 we focused a lot last year, which are associated with training the model. How you store the data, how you prepare the data, and how you present the data to the GPU for training was the focus. And Flash did quite well. We had our high-cap QLCs that were used in fast data lakes. We had direct attached TLC SSDs that provided active data sets for the model to train. So a lot of infrastructure got built as a result of this. But now as the focus is shifting to inference, the question to ask, the infrastructure that was built for training, is the same infrastructure relevant? Can that satisfy the growing need of inference? And the answer is no. You can see as we move along, there is disaggregation happening in infrastructure, right? The infrastructure for training is quite different from the infrastructure of inference. So let's look at what's happening inside the inference. So like I said, we have our existing products that go into the fast data lake staging checkpointing, but inference something new, and that's where we'll hone in on KV cache. There are 2 interesting trends that are emerging in inference when it comes to NAND flash. The first is data augmentation, and the second is context remembrance, right? A lot of you, I'm sure, use the models, and if you're using the models, it's becoming more persistent. It remembers who you are, right? So that's the second popular use case. So RAG is one of the most popular techniques that is used to provide external data so the model can provide you much more relevant and accurate responses. Second, the users are wanting richer conversation, smarter conversation, longer conversation. And what ends up happening as a result is a KV cache amplification. And the KV cache amplification, the way to think about is you're having longer context length because you want longer conversations. You have longer reasoning chains because you want iterative process. You want the model to know